Hi, everyone. This is Scott McLeod from Brown Financial Advisory. Wanted to spend just a few minutes with you today. I've gotten some feedback from clients that the market volatility has made them a little bit nervous, not unusual, but I wanted to put it in perspective a little bit because it's maybe not what you think. And so I want to spend just a few minutes talking about where the market really is, not what the media says, and also where we think we're headed. So let's get started. First thing is share just a bit of a disclosure with you, and then we get into the agenda for the day. And right now, I want to talk with you about where the market is now. What about the valuations of the market, which lends itself to knowing what's going to happen next? And then also finally reviewing some of the things we've talked about before regarding similar market cycles. So the first thing I'd talk about is where the market is now. And the headlines today on Google: Dow plunges 300 points as the FedEx warning spooks the investors, and Dow drops 300 points as traders fret over FedEx warning. That poor guy on the bottom right looks like he's just about lost everything he can think of. A 300-point drop in the Dow amounts to 0.86% on the current Dow level. So I wouldn't consider that exactly a plunge, but we keep hearing cycles like this and announcements like this over and over again during this period of volatility, and that's not unusual. In fact, I want to share with you what's actually happening in the S&P 500, and you can see on the graph on the right here, the S&P 500 has declined, but it rose again shortly after that and then declined again. So I had a client tell me this week, he said, I was looking at my statements and I was worried, but I eventually saw that I had lost the same $100,000 twice. And what he was basically saying is he saw the statement when it was here, and then the market rose, and then he saw the statement again when it was here. And as a result, he lost the same $100,000 two times over. But basically, we're where we were right about June 10th. So we haven't really made a whole lot of progress either up or down for a few months now. And if you listen to just the headlines, you'd be convinced that the market is declining every single day, but that just really isn't true. We saw significant declines back at the end of June, recovered through July and August. We've seen the market sell off again toward this period in September, and we expect continued volatility into the fall, but that doesn't necessarily mean we're going to see continued declines. In fact, if you remember from my presentation a few months ago, the market works like this. Basically, you're thinking that the market is going up. Your brain tends to tell you that the market will continue to go up. But when the market is going down, for example, your brain tends to tell you that your market is going to continue to go down. And really, the opposite is usually true. In fact, when the market gets too high, instead of continuing to go up, it tends to pull back. And that's basically what we're seeing right now. But on the other hand, after the market has fallen significantly, we tend to see the market bounce and it heads back up in the other direction. So that's essentially what we're waiting for. We're waiting for that next bounce because we're getting at a point now where valuations are starting to look pretty fair. So what do I mean by that exactly? And in fact, where are valuations right now? When I talk about valuations, a valuation is essentially what the market is worth. And you only know that by looking at history to see, where the valuations were and what the subsequent returns were following those valuations. So we measure that in a number of different ways. This is a great, very busy chart that kind of talks a little bit about what's happened recently. And as you can see, the valuations have dropped here to points that we really haven't seen since about 2018. So we saw a temporary drop in 2020, as you know, when the market sold off. But in 2018, we got a pretty healthy correction during that period, and valuations dropped to this level. So this is a level, as you can see at 15.9, that is actually about where the 25-year average has been for the market. So at points they've been overvalued, and at points it's been significantly undervalued. But right now we're pretty close to the average, which puts us at a place we would say the U.S. market is approaching fair value. Now, I will say this: if you look at the chart in the middle, you'll see valuation metrics like the CAPE ratio, like the dividend yield, et cetera, that still imply the U.S. market is a little bit expensive. So I would say the upside on the U.S. market is modest, if anything, right now. And we've got a little more volatility as the Fed figures out what to do next with the inflation rates and so forth. But I will show you this next chart, which is very, very compelling. When you look at the stock market returns, they tend to track very closely with corporate earnings. And so the lines on the axis here, if you look at the black line, you're talking about the S&P 500, and then the red line is the S&P 500 earnings. And you see how closely they track together. Well, when we look at the forward earnings projections from 22, the end of 22 and 23, and then map out the stock market, well, you can see how the earnings are projected to continue to go up through those years. It's not as if we're expecting earnings to decline going forward. They're expecting to continue to improve, but we'll see those earnings maybe grow a little bit more slowly, but still expected to improve through 22 and 23, which means if the black line tracks along with the red line, then the black line will be upwards of near its peak somewhere near the end of 23, or maybe even as far out as maybe early 24. But the idea is that as earnings improve, we would expect the market to improve as well. And so the growth rates from here actually look relatively compelling. The next thing I'll share with you is what's been going on in the international markets, even a more compelling story. If you look at the graph on the left-hand side, what we've seen is that the prices of the international markets have pushed those valuations down. So when you consider forward earnings expectations and the current prices, now we're trading at significant discounts to the US market. In fact, we're trading at almost a 27% discount over the ex-US markets, over the S&P 500. So what that means is that international markets are trading at a significant valuation discount to the US market, but not only just the US market, also to international markets themselves. So if you look at the graph on the right, what you'll see is the average at the bar, and then the star is where the markets fall. And you can see the US is trading pretty close to fair value. But look at the discount on Japan, significant discounts on Japan, on China, on Europe, a little bit on the emerging market space. So all of those are trading at discounts to their long-term averages, whereas the US is trading at about where the long-term average falls. And when you look at them in relative valuation terms, international stocks are trading at 26, 27 times, 27% discount to the US market. The reason that that's important is because we tend to see cycles from US to international stocks. And if you look at this graph, every time you see this mountain, you see international stock outperformance. And over the time frame, there's a shift back and forth where US stocks outperform for a period, and then international stocks outperform, and then US stocks and international. Well, what you'll notice on the end of the graph is this giant mountain on the end suggests that US stocks have been outperforming for the longest period that we've seen in 50 years. What that means is that with this valuation discount overseas and US stocks still trading at roughly fair value, and this long-term outperformance that we've seen in US stocks over international stocks, that there's a very high chance that in the not too distant future, you would tend to see that shift, and we would see that international stock outperformance begin to take over. Now, of course, international stocks have fallen out of favor because of things like Ukraine and inflation rates in Europe and the declining growth rates in China, et cetera. So you can make a long list around those things. But basically what we're anticipating is that we'll see those stocks normalize right along with the US stocks, and we'll likely see some outperformance in the international space due to those valuations. So the last couple of things I want to share with you is that as we review those markets, I'm going to recap a couple of the things that we saw in our previous slides. And the first one that I'll remind you of is that these declines around that 20% range, as you can see on this right part of the chart, are not unusual. In fact, they come around about every 6.3 years on average. So they're not uncommon to see declines like this, and they're not permanent. So in other words, they generally last about 425 days. If you remember the math on that, that's roughly 14 months. So we're well into this decline, as we've talked about before, but they don't last forever, and we don't expect them to last forever. Now, that's an average, so that average could extend beyond February, March, April, and we're expecting it to maybe stretch into the early part of next year, possibly normalizing by the middle of next year. But as you saw from the earnings chart, not unlikely that we wouldn't see a market recovery at some point in the next 12 months. So the next graph that I want to share with you is a very compelling graph about what's going on in the markets. These are the 12-month recovery after a 15% or greater decline in the stock market. So as you remember from our previous presentation, the average 12-month return after a steep steep decline in the market is 55%. Now, I want to take out again the Great Depression up here at the top, because that tends to skew the average a little bit. But even without the Great Depression, you're still saying that the market recovers somewhere around maybe 35–40% on average after those steep declines in the market. And that's not atypical. As you can see, it happens very, very frequently. In fact, it happens more often than it doesn't happen. And so as a result, we would really expect a bounce in the stock market after this market tends to begin recovering. So when is that? Well, I'll show you. In general, what we see are markets that climb and then decline, climb and decline. And this is a cycle that we see over and over again, bear market cycle. But the difference is in how we make money in markets like this is that the climbing tends to be a lot more than the declining. In other words, you might see declines that are on average 33% in the average bear market. That's significant. We've seen that in our lifetimes. In my career, a couple of times I've seen markets that have declined that and even more, but they only typically last about 14 months. However, when you look at the bull markets that come after and the bull markets that surround all these brief bear markets, you expect a return on average 263% return after the bull market begins. So what you see is a bounce on the bear market, and the bull market returns 263% on average. So what we see is very short bear markets with relatively limited downside performance. But if you're positioned correctly and you stick with the market, you expect the bounces to last much longer, 71 months on average, and to produce outstanding returns over that time frame. So I wanted to share with you that we're in this situation right now where the markets have begun to decline a little bit, and we're still seeing volatility. We expect volatility into the fall. We expect the Fed to continue to raise rates, but valuations are starting to look a little bit more like the average valuations, which means they have a little bit more downside protection. In other words, the market is less likely to fall further as the valuations become more fair. And so as the Fed continues to raise interest rates, as we continue to see volatility, and even more importantly, as you tend to see the market cycles that create the news cycles that spook you, like the plunge of 300 points on the Dow, remember that the market recovers quickly when it begins its recovery, and the bull markets last much, much longer than the bear markets. The bear markets aren't any fun, as you know, because we're living through one right now, but the bull markets tend to pay us off if we can just be persistent, be patient, and trust that the market tends to do this over and over and over again, and it works out fine in the long run. So I hope you'll remember this, and I hope this has been helpful. Please let me know if you have any questions. I hope you have a great weekend, and I look forward to talking with you soon. Thanks a lot.